Okay, I see it's 11:31. Good morning, everybody. Welcome to our Thursday questions and answers session, where we have the privilege of having one of our analysts in the meeting, and they will gladly deal with any of the questions you have regarding the company that we're discussing. Today, we'll be talking about Redefine Properties and the opportunity that lies therein. Fiso Kushle is the guy who did the research for us, and we look forward to him sharing the insights that he gathered from it. And then Sean will take the technical bit, and straight after Sean's technical bit, I think we'll open the floor to questions and answers. You're welcome to type your questions in the chat box of this meeting, or you can ask them outright by switching on your mic and your camera. I'm going to hand straight over to Fiso. Thank you very much for sharing with us.
Thank you, Sarl. Good morning, everyone. Like Sarl said, my name is Fiso Mbuto, and today I'll be taking you through some of the highlights from our Redefine company update report. So just to start on the summary side of things, Redefine came up with the FY24 results earlier this month, which were pretty decent and in line with management guidance. There were two areas that we continue to track. One of them being the office exposure, and that's been a continuous area, and the other one being the interest cover ratio, which has come down a little bit. But when we do a look through of the results themselves, we have not changed our view on Redefine up until this point, and that's why we maintain our buy recommendation and have that intrinsic value of R5.50 with an upside of about 14%. In conjunction with looking through the results, the reason why we maintain a buy recommendation is that we still see a further potential outperformance, primarily driven by continued yield level depression. One of the catalysts we see there is the interest rate cutting cycle that we've started to come in now, as well as a continued expectation of just a reversion of those levels to long-term averages. The current level right now is at about 10.44% for the SA long-term bond yield, 10-year bond yields. And the long-term average is at about 9.6%. So there's still quite a bit of potential outperformance there for redefining the sector as a whole. Since the last report, which would have been in August, yields have fallen about 40 basis points, and we've seen a little bit of an uptick in the share price as well. Again, we still are optimistic on redefining the sector, and there hasn't been any new information that has warranted a complete change in our view, and that's why we maintain that buy recommendation. In terms of things that would change our mind, and that has stayed quite consistent in the last in all the versions of our company update reports for Redefine, is one being a deterioration in property fundamentals. So we would have seen that our property wasn't particularly doing well during the COVID period. And things that we track the most are the reversions, which are usually a good line in the sand for what demand looks like for that kind of property space, as well as vacancies as well. And so that's one of the things that we take a look at. The other one would just be a change in outlook to government bonds increasing instead of decreasing, as well as having a negative impact on property performance. Again, keep a keen eye on these two topical points that would have a material impact in terms of change, in our view for Redefine. Just to go through some of the important bits from the results themselves, first bit I'll start with is the FY25 guidance. So that's pivoted towards positive. You would have seen that for FY24, they expected the distributable income per share to either fall by 7% or only be up by about 1%. But for FY25, they expect a positive property upcycle, and they expect that distribution should be up between 0 to 6%, with the payout ratio of between 80 to 90%. But that typically just means 85, because the payout ratio for this period is 85%. For the prior period was 85 as well. So it's well within reason to expect it to be the same in FY25 as well. Other salient features would just be the group property revenue that's up about 8%. The REIT funds from operations was down about 5%, and it did have an impact on distributable income per share and the dividends per share, which were down about 3%. Again, still at the midpoint of guidance. The interest cover ratio did pull back a little bit from about 2.4 to 2.1, and it is still just above the rule of thumb level about 2 times. But what they did do within this period is negotiate their covenant down from about 2 times to 1.7 0.75 times up until August 2026. So it does seem like they do expect a little bit of pressure coming from this metric, but they have been able to negotiate the covenant down in the occurrence that the interest cover ratio comes down further than that 2 times. In terms of the loan to value, that did uptick a little bit, but it was well within management guidance. So it went up from 41.1 to 42.3, and it was primarily driven by that Mall of the South acquisition that they had during the period. In terms of the SA portfolio, so it looks to be doing a little bit better. From an occupancies perspective, those are up about 20 basis points. Retail was up about 140. Office did a little bit better, up 20 basis points as well. And industrial did have a little bit of a pullback, but over the last, call it 3 to 4 years, the industrial segment within property has done quite well, particularly in reversions and in occupancies as well. So I'm not too worried about that at this point in time. When it comes to reversions on the SA side, which would be a good indicator of demand, they did become a little less negative, which is good. But if you cast your eyes down there, the primary driver is actually just office. Because when you look at retail, it went from minus 4.1 to a positive 0.2. And that's something that we had been anticipating, a nice pivot from negative to positive territory from the resale side. Industrial just becoming a little bit more positive from 2.1 to 5.5. And then that contentious point just being office, which did get a little bit more negative. And they do expect it to get a little bit worse in FY25 because they have a lease renewal coming up, but they said they would give us a little bit more information as it occurs. From the Polish side, so the Polish portfolio occupancies are typically quite high. EPP, which is primarily retail, that was up about 0.7 basis points from an occupancy perspective. And then ELI, which is basically just the logistics side of the business, the occupancies there were up about 0.9 basis points. And then from a reversion perspective, there has been an expectation of EPP / the retail side to pivot from negative to positive territory, similarly to how we've seen it in South Africa as well. And that has been the case, moving from negative 7.2 to a positive 0.2. The logistics business has been doing quite well over the last couple of periods, and it did get a little bit less positive, but it has continued to be positive nonetheless. Just to contextualize the risk around the office space a little bit more, just wanted to put together these two charts and speak on them. But what we'll see is that the vacancies are primarily concentrated in that secondary and A-grade space, with Gauteng being the bigger region of concern. But if you cast your eyes to the chart on the left, what you'll see is that 54% of the office exposure is in quality assets, premium assets. And the vacancy there is just about 3%, which is quite low relative to the average of all the other property guys with office exposure. The A-grade space, still considered a quality space, has vacancies of about 16%, which is about in line with which is about in line with the kind of vacancies we're seeing with the other property guys with office exposure as well. It's only really the secondary office space that's seeing very, very high vacancies, but Redefine has a quite small exposure to it, only about 5% of their assets. So it does contextualize their risk a little bit more, where if you are concerned more about vacancies, you're more really concerned about the vacancies on the secondary side of the business, but it's only about 5% of the exposure. So it does contextualize the risk a little bit better. And we would have seen the big area would have been Gauteng, particularly Sandton. That's where the vacancies really are. And 72% of Redefine's exposure is in Gauteng, the 25 being in the Western Cape, and then the remainder being in Limpopo and KwaZulu-Natal. So you can see that there still continues to be a risk in office exposure, primarily because there has been a structural change in the kind of office space that is demanded. But given the kind of quality that Redefine has, it contextualizes the office exposure risk a little bit better. Then just to look at performance, valuation multiples and yields. Again, yields would have fallen about just under 40 basis points since the last report in August. And property continues to outperform the all share. Redefine is outperforming the SAPI as well as the all share over the 12-month period, as we've seen as a trend amongst the property guys. But if you cast your eyes to the chart on the left, what you'll see is a continuation of that relationship we expect from yield levels compressing and valuation multiples getting an uptick. What we do expect is that because the levels are still quite high, and the interest rate cutting cycle that we've got into now should be a catalyst for yield level depression. We can expect to see that multiple go as high as about 15 times, which is our bull case in this instance. But we do acknowledge that our property has had quite the run in the last 12 months. So I'd just like to cast your eyes to the slide. It's more used to keep track. We used it to keep track of where inflation is relative to the sub target band of between 3 to 6%, as well as when we would start anticipating an interest rate cutting cycle to start. And since the last report, we have seen a change. And that's one of the catalysts we expect to have a positive impact on yield level compression, as well as an uptick in property performance overall in this specific instance being redefined. So from a valuation perspective, we still see some upside in Redefine. We have that intrinsic value of 550 with that upside of 14%. But what we do acknowledge is the big run that the share has had. And that's why we have weighed up the scenarios the way that we have. So if you look at the bear case scenario, we weighed it up at about 30%. And the reason why is because if you look at a 5-year period, because this chart looks at a 10-year period, the multiple has elevated by quite a bit, getting as close as being up 1 standard deviation from that 5-year average. But because we expect the catalyst to continue to put pressure on the yield levels, we do expect it to get a little bit higher, but we have to take that risk of downside into consideration as well. But weighing it all in, it does still present Redefine's value proposition as skewed to the upside. And that's why we continue to maintain that buy recommendation for Redefine. I'll just hand over to Sean now to speak on the technicals.
Yeah, good morning, everybody. Thanks, Lisa, for a comprehensive presentation. Yeah, you can see the share price of Redefine. I took the screenshot from yesterday, last night's close. You can see the share price is trading below its 20-day and 50-day moving averages. So the medium-term trend is bearish. You can see those two moving averages also have crossed over each other. The long-term trend, however, remains bullish. That's that yellow line. The share price is still trading far above that 200-day moving average. So, as I say, it's still bullish. In the short term, the share price has recently broken below that lower support trend line of that, call it narrow down channel. And is now testing or bouncing off the support at about the 461 level. And the last I saw, the price was up today. It was trading about 472, so it was about 1% up. I see now it's just about 0.5% up. So it's bouncing off that support there at about 461. So the MACD indicator is trading in oversold territory. So it's crossed below that zero line into oversold territory, and it's trading below its trigger line. And this is just basically confirming that last bearish price action. But saying that is, if you could take a contrarian approach, is when else is selling, you want to be buying. So as Fizo says, we have intrinsic value at 550. You can see it right at the top of the screen there, and hence our buy recommendation. So I think it's great opportunities right now. Thank you.
Thank you very much, Sean. Thank you, Fizo. Yeah, if that support line holds there, it'll definitely, it may do a bit of work around there. But if that support line holds, then we could definitely see it rebound and go up maybe to the intrinsic level values, or at least to the upper resistance line. Okay, I'm going to hop into the chat here quickly and see if the audience has got any questions for us. I don't see any questions yet. Is anybody? Oh, there we go. Are you able to share a EPS dividend yield, vacancy figures across the property shares on the JSE. Fiso, do you have that offhand? Do you have a comparison between Redefine, Growth Point, and so on?
In terms of,
so on.
Sorry, say that again.
It looks like the client's asking for a comparison between the different property shares. Just to talk a little bit about Growth Point, maybe Redefine. Which ones do you think have more potential than others?
I don't
think you have the EPS or the dividend yields at hand, to do a comparison like that now. But maybe just talk to what you think the different property shares, who's in a better position.
Yeah, so I mean, there's a lot of things really to think about here, and when we contextualize the property sector, we all know that it hasn't been the greatest place to be in the last, call it 5 years, excluding the last 12 months. There's been a couple of reasons as to why we've started to see an uptick and why I think that we should continue to see a positive upcycle. So the first being, we had about, call it 2 to 3 years where we had to work off very high finance costs because we're a high interest rate environment. So what we're starting to see now with the guidances from most, if not all, of the property guys is that they're guiding a lot more positively. So it's one of the points that I was mentioning in the presentation that in FY24, they were expecting as much as a 7% decrease. And it was primarily driven by these finance costs. But now we're starting to see that interest rate cutting cycle. So we should see a good amount of uptick in terms of distributions, as well as guidances on the positive side of things. I think it is important to contextualize the kind of exposures that you're going to be getting from these different types of property guys. So if you look at like a Redefine, for instance, it is a diversified REIT. And the reason I break down the kind of office exposure it has is because it is a contentious point, being about just under 30% of their revenue. But it also does have offshore exposure. So that does help you a little bit. So if you're trying to pivot a little bit more towards offshore than local, you do have a couple of options. You have the Napier Castles, you have the Growth Points, the Siriuses, but the value proposition still remains to be a lot more SA focused, given the relationship that the SA focused property guys have with the bond yield levels, which are still typically high relative to the last 10 years. And with that interest rate cutting cycle, we could expect that to catalyze those levels further down. You could get into the nitty-gritties as to which specific companies, and it all boils down to how long it has taken them to pivot out of that negative impact of the high interest rate environment, particularly on the finance costs, because that is a very big impactor when it comes to what the distribution/dividends will actually look like in the following year. So I don't have those numbers offhand, but I was hoping that what I've just said now contextualizes the sector a little bit more, depending on the kind of interest the client has. Maybe there's a more specific question on a specific company. Maybe I can get around to that.
No, I think you contextualize it well. Thank you very much. I think Sudesh will be happy. We don't have a comparison between the different companies, but you've said it. It's all about, I see he's giving us a thumbs up there. Thanks, Sudesh. I think it is about how these guys are recovering post-COVID and these high finance costs, with people going back to the office and so on. Office being controversial because some companies have adopted a work from home approach. Some others have not and have returned to office with full staff complements and continue to do so, because it's one thing being able to log into a computer and do some work. It's a different thing when you're sitting amongst people.
It is.
And I think the productivity, the companies will come to realize that the productivity will probably be slightly elevated when the guy sits at home and is a bit more relaxed than that, but over time it'll come off, because no man's an island. So and I think teams work together much better when they have regular contact and not just through Teams meetings. So 100%. I think we actually see some more companies returning to office.
I think another thing, sorry, Sarah, just to cut you off a little bit there. Another thing to consider is let's try to look at the breakdowns of those property companies as opposed to just them as a whole. So typically you'll have the retail exposure, you'll have the office exposure, and you'll have the industrial exposure. From the retail side, in terms of sentiment around the consumer, that's getting a little bit better. the environment is getting a little bit better. So what you might start to see there is that the trading densities on the retail side are going to get a little bit better. The demand for the retail space is going to get a little bit better. And that's why we're seeing those reversions begin to pivot from negative to positive, because the demand dynamics are changing a little bit. The other bit would be the industrial, which is primarily, the logistics nodes, the warehouses. E-commerce is growing quite well in the country. So you would expect that the demand for those kind of spaces is going to continue to increase. Yes, office is a very contentious point, and we are seeing some of the property companies sort of pivot to reinvent their offering in office space. So it is going to be quite a while before we see proper pivot from negative to positive in terms of the reversions. But there are catalysts in place which seem to support an upward cycle for property, at least in FY25.
I hear what you're saying, but I tell you what, driving around and seeing malls going up everywhere, I'm wondering whether a place like Woolies would have a shop every 400 meters, and whether that would really be smart. But I just see malls going up everywhere. So yeah, something to keep our eyes on. I don't see any other questions, guys. Last of the last. No, doesn't look like it. Fissa, thank you for sharing your insight, mate. So we have got a buy recommendation on the stock. The stock's trading almost a buck below the intrinsic value that you put on it. You followed a fairly conservative valuation model to determine that price. And as you've highlighted a couple of the risks that do exist, there's always a risk when buying stocks. But if you're leaning towards some property REITs, then Redefine definitely one to consider. Thank you very much for joining us, guys. And for once in my life, Sean, I don't know what's up next week. I've done it again. Do you know?
Aspen. I think it's Aspen.
Okay, so we'll be back next week, Thursday, and we'll be talking pharmaceuticals, guys. Thank you for joining us. I hope you have a fantastic Thursday. Cheers.
Cheers.